Welcome, everyone. Today we are diving into one of the most powerful tools in a sophisticated investor's arsenal, the CAPE ratio. Developed by Nobel laureate Robert Shiller, the cyclically adjusted price-to-earnings ratio offers a long-term perspective on market valuation that standard metrics often miss. For entrepreneurs and strategic investors, understanding whether the market is overextended or undervalued is crucial for capital allocation and risk management. While the daily noise of the stock market can be overwhelming, the CAPE ratio acts as a signal through the static, helping us identify major market cycles. In this presentation, we will explore its origins, its calculation, and most importantly, how you can use it to drive long-term strategic growth in your portfolio or business ventures. Before we can master CAPE, we must understand its foundation, the standard price-to-earnings ratio, or PE. This metric is the most common way to value a stock, calculated by dividing the current share price by the company's annual earnings per share. It tells us how much investors are willing to pay for every dollar of profit. However, the standard PE has a significant flaw. It is highly sensitive to the business cycle. During a recession, earnings might temporarily collapse, making the PE ratio look alarmingly high, even if the stock is actually a bargain. Conversely, during a boom, peak earnings can make a stock look cheaper than it really is. This volatility can lead to poor decision-making for long-term investors who rely solely on trailing 12-month data. Why does the standard PE fail us over long horizons? The answer lies in the E, the earnings. Corporate profits are notoriously cyclical, meaning they fluctuate based on the health of the broader economy. A single year of record-breaking profits or a sudden temporary loss can distort a PE ratio, making it an unreliable compass for a 10-year investment strategy. For entrepreneurs looking to benchmark their own business valuations or invest surplus capital, relying on a snapshot of time is risky. Robert Shiller recognized that to find the true value of the market, we needed a way to smooth out these peaks and valleys. We need a metric that accounts for the fact that profit margins eventually mean revert over time, rather than staying at extremes forever. The CAPE ratio, often called the Shiller PE or PE10, solves the volatility problem by changing how we calculate earnings. Instead of looking at just the last year, CAPE uses the average of the last 10 years of earnings. But it doesn't stop there. Because a dollar today isn't worth what a dollar was worth a decade ago, Shiller adjusts each of those 10 years of earnings for inflation using the Consumer Price Index. By using a 10-year rolling average of inflation-adjusted earnings, the CAPE ratio effectively filters out the temporary effects of the business cycle. This provides a much clearer picture of the market's long-term earning power. It is a more conservative and realistic gauge of whether current stock prices are justified by fundamental performance. Let's look at the mechanics. To calculate the CAPE ratio, you first gather the earnings per share for the S&P 500 for each of the past 10 years. Each year's earnings are adjusted to today's dollars using inflation data. You then take the average of these 10 inflation-adjusted figures. Finally, you divide the current price of the S&P 500 by this 10-year average. The result is the CAPE ratio. For example, if the current price is $4,000 and the 10-year average real earnings are $125, the CAPE ratio would be 32. This number tells you where we stand relative to historical norms. While it may seem complex, the underlying logic is simple. We are comparing the current price to a decade's worth of proven inflation-protected earning power. To use the CAPE ratio effectively, you must understand its historical context. The long-term historical average for the CAPE ratio is approximately 16 to 17. When the ratio is significantly above this average, the market is considered overvalued. When it's below, it's undervalued. Historical peaks tell a cautionary tale. In 1929, before the Great Depression, the CAPE hit 30. During the dot-com bubble in 1999, it soared to an unprecedented 44.2. Conversely, during market bottoms like 1982, it dropped into the single digits. While a high CAPE doesn't mean a crash is imminent tomorrow, it strongly suggests that future returns over the next decade will likely be lower than average. For entrepreneurs, this is a signal to be more selective with investments. How should a modern professional or entrepreneur apply this? First, recognize that CAPE is not a market timing tool. It won't tell you when to sell everything, as markets can stay overvalued for years. Instead, use it as a risk management compass. When the CAPE is high, consider increasing your margin of safety, diversifying into different asset classes, or focusing on high-quality businesses with strong cash flows. When the CAPE is low, it's often a signal of generational buying opportunities. Many successful wealth managers use CAPE to set expectations. If you're entering a market with a CAPE of 35, you should expect much lower annual growth than if you entered at 15. It allows for strategic patience and more disciplined capital deployment in your business and personal accounts. In summary, the CAPE ratio is one of the most intellectually robust ways to value the stock market. By smoothing out earnings over a decade and adjusting for inflation, Robert Shiller provided us with a lens to see past short-term euphoria and despair. For the entrepreneur and the long-term investor, the lesson is clear: price matters. Paying too much for future earnings, even in great companies, can lead to poor long-term results. Integrate the CAPE ratio into your quarterly market reviews. Use it to check your own biases and stay grounded when the headlines get too noisy. By understanding where we are in the valuation cycle, you can make more informed, strategic decisions that protect and grow your wealth over the long haul. Thank you for joining us for this deep dive.